Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Let's go through Tesla's Q4 earnings report and try and infer what is actually happening here by interpreting what the numbers are really telling us and see what we can establish what is going on within the company. Firstly, Tesla's auto revenue was $500 million higher than I expected. This implies that Tesla has a higher average selling price than I initially thought. This would be due to the price rises we started seeing earlier last year and more Model S and X sales at a higher price point, with an ASP this quarter of over $50,000. For comparison, this was around a 4% increase in average selling price from Q3. This is particularly impressive also, given that a lot of the increase in deliveries for the quarter can be attributed to the ramping up we saw in Shanghai, particularly with the Model Y standard range, which is a lower priced model. Despite this average price increase, Tesla's margin only rose 0.1% to 30.6%. I was hoping to see this higher at around 32%. I think that Tesla are actually having to pay higher for certain parts due to supply chain constraints. Possibly they're paying more for chips to make sure they can secure a higher supply too. Then there's likely also some real inflation involved too. And Tesla say they are experiencing rising raw material, commodity, logistics and expedite costs. Yet saying that in the earnings report it stated that they saw a further cost per vehicle reduction. The Model X was being ramped up this quarter too. When the Model S was first being ramped up it did affect margins, although I believe they used the same production line, so it's possible this may not be the case. Anyway, in a sense, all margins at this stage are moot. These low margin, for lack of better word, cars being made at these existing factories, their capacity will soon be pale in comparison compared to what the newer factories will produce. It's the margins from the cars from these factories that really matter. Likely somewhere between 45 and 55%. Easily that with FSD. That's the margin that actually matters. The margin that Tesla are potentially capable of reaching, not what they're doing now, particularly when we're aiming for 20 times as much production later just this decade. The margins Tesla show now just affect short-term stock prices and not long-term growth. Energy revenue was down a little this quarter and was actually a gross loss. It had been breaking even previously. Services is up slightly with a slight loss as usual. Nothing much to expect from these sides of the business for some time. And the auto revenue is just going to tower over them for this period. So far, no major surprises. All within what we might have expected. But now we get to Opex, and R&D is up a bit. Quite possibly more 4680 development, and maybe some LFP research perhaps too. It doesn't sound like much of the R&D is going into the compact model or other new models, so likely mainly battery technology, or maybe even the humanoid robots. But the real surprise was selling general and admin up so high. We had SG&A up to $1.5 billion. That's a 50% increase from last quarter. However, this was explained that it was comprised of stock-based compensation and payroll tax associated with the exercise of the 2012 CEO options. The total cost was over $700 million. This is more of a one-off expense and not reflective of the success of the company. There was also reasonably large recall costs that Tesla had to face earlier this quarter, which hopefully shouldn't be a regular expense either. This was really the main thing that I don't believe anyone expected and caught us off guard. The rest was fairly close to what I had thought. There isn't really much else to talk about there, really. Anyway, earnings came in at $2.3 billion. If we annualize that, it averages at $9.2 billion. At the time I'm recording this, we have a stock price of $846 and a market cap of $859 billion. This comes in at a P/E ratio of 90 based on that quarter. The crazy thing is that this comes in at a trailing 12-month P/E ratio of only 172. Now, I'm of the belief that there's a high chance Tesla will show a quarterly earnings report sometime in 2024 that will show above $23 billion in earnings, i.e. 10 times this quarter. In other words, we're basing the value of this company at 90 years earnings, and in 2 to 3 years, earnings could increase 10 times. That is a lot of growth. Operating margins were down this quarter, but they would have increased, again, if it had not been for those one-off expenses, like the $340 million payroll tax on 2012 CEO award option exercise. I calculate operating margins would have been closer to 17.5% if it had not been for these. Of course, in the future, when Tesla's revenue is up 5 times, any minor fluctuations like these will be relatively less noticeable. Just a reminder of how early Tesla still is in its growth stage. Again, these margins will be significantly altered by the margins achieved from the vehicles in the new factories. That will be a much bigger deal of what Tesla can achieve, rather than just what they're doing today. The more you think about it, the more you think how little significance the current operations actually indicate. Tesla are about to level up in a big way. Despite how great this quarter actually was, we haven't seen anything yet. We have 4680 batteries coming out this quarter. This is good news. As for the share price, well, it sounds like there is blood out on the streets, and maybe more to come. Tesla's trailing 12-month PE is down to 173. Comparing to if we analyze Q4 profit, then we have a PE ratio of 90, about half the trailing 12-month PE. But we're seeing a forward PE ratio of 100. How can Tesla have a forward PE worse than the equivalent PE for Q4? Tesla's actual forward PE right now has got to be closer to 40. If by Q4 2022, Tesla are at about twice the run rate they were at in Q4 2021, i.e. expecting around 600,000 deliveries for 2022 Q4, then surely net profit would have increased closer to 3 or 4 times. I'll have my 2022 projections out sometime early next month, then soon after that my 2025 projections. Well, that would mean in a year's time, the PE would be down to 30 or so for a trailing quarter PE ratio if the stock price remained where it was today. And this is how I look at things. I don't deviate too far from the fundamentals. What I'm saying is that at the current stock price, Tesla could easily have a PE ratio of around 30 as early as this time next year for a PE ratio solely related to that quarter, i.e. not a trailing 12-month PE, which is more relevant when a company is growing at this rate and if the stock price didn't move from now until then. For Tesla to have a PE ratio that low at a stage so early on that they aren't even selling cars with their own batteries yet, to me it seems like a good investment. I'm not suggesting to buy it, I'm just helping you put it into perspective. We never know what will happen. It could drop even further. These are uncertain times, but despite how strong the macro effect can be, within a couple of years, the micro effect inside Tesla will outweigh any potential down economy, let alone 5 or 10 years' time. The only issue is to make sure you can cover yourself in a down economy without having to resort to selling your shares. The Warren Buffett phrase comes to mind of, only when the tide goes out do you discover who's been swimming naked. Make sure you haven't overstretched yourself and aren't at risk of losing your house or having to sell shares. Some of you are possibly even going one step further and waiting for such an occasion to buy it big if one ever arrives. This is known as contrarian investing. Tesla is still very much a growth company, as we know, and they haven't even started making their own batteries yet. Well, not selling them in the cars yet at least. It's a growth company that's barely gotten started and has a lot of orders to fill. Tesla has a long way to go. However, due to exponentials, even the growth over the next 2 years alone will be a huge improvement. I think the macros have changed the environment somewhat, and currently the market is giving lower PE ratios. This may be the way things continue, and we have to just accept there has been a market readjustment and hopefully not a crash. But factoring Tesla's potential growth relative to the current PE ratios, Tesla does seem like good value. And I've put my money where my mouth is and have had the confidence to have recently purchased another Leaps. Now back to that $700 million in SG&A. If this was a one-off payment that we wouldn't expect in other financials, then what if we removed that? I don't think we can remove all of it entirely, so let's be somewhat conservative here and scale it back to $500 million to see what effect this actually would have. This is just for indicative purposes. We know this figure should be around $500 million, thus reducing SG&A to an even $1 billion. Bear in mind, this was a very high R&D quarter too. There's possibly an additional $100 million there that is not usually spent. In fact, I think this may be the most Tesla's ever spent on R&D in a quarter. I'm not sure if this is a sign of things to come, and Tesla will be spending more on R&D regularly now. Perhaps with new battery technologies, or maybe advances with the humanoid robot. Tesla are known for very efficient spending when it comes to R&D. Therefore, anything spent here will within time produce brilliant returns. Without that $500 million in SG&A though, we reach over $2.8 billion in earnings, which is a trailing quarter PE ratio of just 75. Tesla will double deliveries this year with vehicles that have about 50% higher margin than before, whilst Opex will remain relatively low. Tesla should at least triple their earnings this time next year, but possibly even 4 times. Just at a quick guess, I think Q4 2022 should have in excess of $10 billion in earnings, even with a ludicrous PE ratio of 50 on that, and we have a $2,000 stock price. All in all, I think the financials were slightly better than expected. I just thought auto margin would have been slightly higher, but perhaps Tesla are having to spend more on chips. It's still a great margin, and at least Tesla have shown they're able to sustain such a higher margin, and it wasn't a one-off. It was good to see the average selling price increase, and I suspect we will continue to see that for some time, as we have other price increases catching up, along with Texas and Berlin vehicles. Like I said, there weren't really many surprises in the earnings report. Of course, we all follow this thoroughly and try to examine and predict what it will be beforehand anyway. The better job we do, the less surprised we should be. I thought the earnings call was far more interesting though, and we'll be discussing that at length. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.